Hello everyone, my name is Mikhail Krikchin and welcome to my channel. The topic of my video today is one where I will look at a conservative multifamily investment over the next 10 years and show you how it's still a great return investment in any market. Over the next couple of weeks, couple of months, especially towards the end of Q1 and Q2, we're going to be seeing a lot of negative news about real estate all across the media, and they're going to be bashing real estate and saying how real estate is bad and so forth. Meanwhile, over here, I'm going to show you a real life example with today's numbers to show you how you're still going to generate tremendous wealth over the next 10 years as long as you are investing in real estate and also as long as you are staying in a conservative investment, which is going to be the multifamily investment. Quick intro about myself. My name is Mikhail Krikchin. I'm a broker and investor in the Canadian market. I have license to trade in the Quebec and Ontario markets, and I've been doing real estate for the last 20 years. So this is a niche, the multifamily sector, that I understand very well. So let's look at our example for today. What I've done for this example today is I'm focusing on multifamily and why multifamily and not other asset classes. I'll do a quick recap on the multifamily sector for those who are interested. So multifamily is an asset class that I believe works in any market, good or bad, because when you're renting out multifamily as a landlord, if the economy is very good, then people are going to be looking at buying condos, buying houses. Maybe interest rates are low and they're basically moving on and doing other things and being able to buy other real estate that they're able to buy themselves. Meaning for you, you're getting your apartments back that you can then renovate and then re-rent them out to future tenants. Let's say if the economy is bad, like the market we have now, I would say this is a bad economy for real estate because interest rates have gone up so much the last 12 months, especially since early 2022. And what this did was it created a lot of chaos, a lot of issues, and people now are able to borrow less. If they can borrow less, they can pay less, and all of a sudden real estate became a bad sector. Guess what? For the tenants, those who can't afford to buy houses or condos, then they're going to be renting apartments. So as a landlord, as a multifamily owner, you're laughing either way. Good economy, bad economy. As long as you're giving the tenants good quality apartments, you should always be full. You should always be rented. Other asset classes such as industrial real estate, office buildings, retail properties, or let's say storage spaces and so forth, land development and stuff, that's going to be different asset classes. I find those classes of assets very interesting, but I like focusing on multifamily or mixed use assets, mixed use being retail on the ground floor and apartments above, because I find those asset classes are a lot easier and very stable in any economy. Now, let's look at the numbers for our example today. For example one, what I've done is that I've said, okay, imagine you are an investor and you are sitting on cash and you're not sure what you want to do. We're not going to talk about any asset classes. Forget talking about stocks and crypto or NFTs or any other asset classes, because those are obviously other investments, but quite honestly, none of us has any idea about how those things will perform over the next 10 years, but we do know how real estate will perform in our example that I'm going to show you today. Obviously, do your own research. Everything we discussed today is all hypothetical, and even though real estate has been great for the last 30, 40, 50 years, who knows what it's going to be in the next 50 years. So let's assume that it's going to perform well, but do your own research, of course. So let's look at this example. If I am sitting on $200,000 cash, or let's say for my example today, I'm going to do an example of I'm sitting on $300,000 cash. This $300,000 cash, if I put it in a bank over the next, let's say over the next 10 years, and this money in the next 10 years, banks going to be giving me, let's say 5% yield. 5% yield over the next 10 years. Meanwhile, inflation, assuming it's going to be at 5%, today it's higher, more like 6-7%, but let's just be 5% over the next 10 years, meaning that the bank gave me 5% yield, inflation was at 5%, so my real return was zero. Okay, so the investor says, you know what, great, so my money didn't lose value, at least I have exactly what I put in the bank over the next 10 years. Okay, they didn't lose money with inflation. Now, let's look at the exact same scenario with somebody buying a very conservative real estate piece. Let's say someone bought a property that's generating $50,000 of net income, and this property they bought for $1 million. The bank gave them a loan of $700,000, so this investor put down $300,000 of cash down. Now, how to raise capital and so forth, this will be a future video. I'll do a long form video probably next week or two. So if you'd like to subscribe to my channel, do so, go right ahead. That way, whenever I do post new videos, you'll be notified as well. Click on the notification bell as well, so that whenever there's new videos, you get right away. I'm focusing only on putting good content about investing in real estate, joint ventures, how to raise capital, and really I'm focusing only on this niche. So this a topic that interests you, go ahead and subscribe. So let's say the investor put down, again, $300,000 of cash down. They got a loan of $700,000. The bank gave them a loan of $700,000. In my example, I'm going to do a scenario where they went to CMHC, which is the Canadian Mortgage Housing Corporation, because CMHC is an entity that we use when we don't want to put down the full down payment. In our market today, probably the last 4 or 5 years, what's been happening is that the bank assessed evaluations are coming much lower than the sale prices. That's why investors are going with the Canadian Mortgage Housing Corporation to get this loan insurance. That way they could buy the property with less cash down. So in our example, $300,000 of down payment, $700,000 of borrowed money from the bank, CMHC fees of 4.75% for this loan insurance. That means they're basically borrowing an amount of around approximately $733,000. So what's going to happen over the next 10 years? This investor, basically, they put down, by paying down their mortgage, and for my analysis, I've done an amortization of 35 years, and I've done an analysis using a calculation of a mortgage rate of around 4.6%, which is very in line with today's rates, what we're seeing with the CMHC insured loans for the next 10 years. So the investor borrows $700,000 with the CMHC fee, $733,000. They're basically doing a monthly payment of the bank of $3,496. Over the next 10 years, they pay down on the loan, and the loan now has gone down to around $625,000. So now they built up equity over the next 10 years of approximately something in the range of, because $75,000, because they basically paid down over $100,000, but don't forget $30,000 of this amount was the amount paid to CMHC, meaning that their amount that they had borrowed of $700,000 now is down to $625,000. Now, assuming that their net income when I bought the property was at $50,000, they were able to increase its net income by 3% every single year. So that means their net of $50,000 in year 0 became a net of $67,000 over year 10. Now, if we do the exact same calculation, let's assume that the cap rates in the next 10 years are going to be similar to today. They may be higher, maybe lower, depending on interest rates. But for the case of making it simple for all of us right now, let's assume they're going to be the exact same cap rates as what we have today. So at the 5% cap rate, at $7,000 net income, the property is going to be worth in 10 years around $1,343,000. So $1,343,000, and they owe to the bank $625,000. So there's significant equity they built here. That means the total equity now is around $718,000. So they had put down $300,000 in year 1, and now in year 10, they basically got the $300,000 plus an additional $418,000. So that means this total return for the investor has been 140% of the amount that they put down payment over a 10-year window. And we're being very conservative. We're not assuming that the rates went down to zero, cap rates went down to zero. We're being very conservative in our calculation, saying that cap rates stay the same as today. The investor only increased the net income with certain conservative numbers of 3% per year. So this has been a tremendous return on investment for this investor. They were able to get 140% return on investment of their down payment. And if you look at this on an annual basis, they were getting basically 9.15% annual return on their equity. I'm not even looking at cash flow. I'm not even looking at how much cash they made on a monthly basis and stuff, because those are smaller numbers and it's irrelevant for this example. So really, just to summarize, it's a phenomenal way of building wealth. Obviously, this is not a get-rich-quick scheme. This isn't happening over the next 10 days, over the next 10 weeks. We're doing a 10-year scenario. But the reality is that when someone is investing in real estate over the next 5 years, over the next 10 years, over the next 15 years, they're staying ahead of inflation, they're building equity, and most importantly, they're building wealth for themselves. If you like this kind of content, feel free to follow my channel. I only focus on multifamily and real estate investing. And next week, I'll be doing a longer form video on how to raise capital with joint venture partners in any market.